Pratik Gupta is our market master today. He's CEO and co-head of at Kotak Institutional Equities. Pratik, thank you very much for joining us. Happy Diwali to you, your team at Kotak, your family. And it's, of course, great to have been chatting with you over the years. Thanks very much. So let's tackle the big question, Pratik, which I think you maybe won't have a definitive answer, but you can give us some color. Foreign selling, Pratik. You service pretty much all the large FIs here in India and in the region as well. What's the sense you're getting really?
Good morning, Prashant. Happy Diwali to all of you at CNBC and also to all your viewers. Thank you for having me on the show today. As far as foreign selling is concerned, we think, unfortunately, the worst is not over as yet, especially as you head into a volatile period over the next 1 or 2 weeks. A couple of things. Firstly, fundamentally, you have the valuations in India, which is still somewhat expensive, even though we've come off about 9 or 10% from the top at the Nifty level. But as far as overall index is concerned, we're still trading at roughly 21 times 1 year forward earnings. Earnings growth is actually slowing down, and we don't have any signs of interest rate cuts either in the US or even in India. Even the RBI sort of pushing back rate cuts. So when you look at it from a valuation, earnings, interest rate or cost of equity perspective, all these factors are working against us. Now, on top of that, like I said, you've got a couple of events coming up. First is the US presidential election next week, which could, either way, we think it'll result in bond yields going up. They've already gone up quite a bit as the US economy seems to be pretty strong, inflation's still running high. And that in turn is putting pressure on EM funds, EM outflows. And as and when the US election gets out of the way, we believe the Chinese stimulus is also likely to come through in response. One way or the other, they've been holding back for the US elections before they come out with their big stimulus package. We don't know how big or the exact timing of that, but in anticipation of that, the Chinese markets are also likely to be somewhat more robust. They've already run up a bit, but they've corrected, and everybody's waiting and watching to see what kind of stimulus China comes out with. So in an environment where with US bond yields going up, outflows or at best steady state situation with EM flows, you could see more foreign selling with money shifting from India to China or other parts of the world. That's one. Second is you have a ton of issuance coming through, IPOs, QIPs, which are coming through, which are likely to suck out liquidity. And even locally, investors are becoming a little bit cautious. And you're right, at Kotak, we do speak to pretty much anybody, any FII who invests in India. And by and large, unfortunately, despite the market correction so far, we still aren't getting any major inquiries or which stocks to buy or what's looking interesting, or are we getting close to price levels which are now worth considering. So by and large, investors still cautious and no rush. We are seeing decent participation in some of the IPOs and QIPs and blocks, but that's very tactical. Most of these things come at a discount to their prevailing stock prices or to their peers. So therefore, there's some interest over there. But it's not a very broad base. So unfortunately, in the very short term, things are looking a bit, we maintain our cautious view in the short term. But then again, if you take a slightly longer term view, we are more constructive. But let me just pause here and see if you've got anything else to ask.
Yes, we do, Pratik. Hi, plenty of questions. Season's greetings to you. Wish you a very happy Diwali to you and your team and all at home. So, I think, the festive season has come at an interesting time where I think investors are being forced to pause and sort of reflect, take a look around and reassess what they need to do. So then let's actually address that. Till we get more clarity on things like US elections, pace of US rate cuts, pace of India rate cuts, when these are beyond investor control, right? Till we get that clarity from a portfolio perspective, would you advise any more tweaks? There's been talk about, of course, taking money off the great capex trade, which I think you folks have already been fairly cautious on, just given the valuations in the run-up. But then consumer isn't quite kicking in. So what do you do? Portfolio call now.
So that's a great question, Surabhi. And I think basically what we are saying is in the coming year, if you look from Diwali to Diwali last year, we've had a great year. I think especially in the small mid caps, they're up about 45%. The Nifty is up some 23, 24% or so. So you've had a great year. Now it's time to get into capital preservation mode and moderating your return expectations for the next 6 to 12 months. And especially at a time when we're getting into a choppy global environment. Maybe things don't turn out to be as bad as we think or as the world is worried about, but nonetheless, one should be worried, especially just given where the valuations are right now. So from an overall perspective, we're advocating a slightly more defensive stance. And what does that mean? That means one, for example, in the BFSI space, you stick more to the large private banks where asset quality is less of a concern, or perhaps even an SPI, which is another one on the PSUs that we like. We like life insurance, which is especially you have the worst of the life insurance woes are behind us. They've had a pretty bad period last 3-4 years with COVID, with regulatory changes, surrender value, taxation, and so on. And there again, we think the worst is over, and also with interest rate cycle in the next 1 year turning down, that looks quite good. Telecom is another sector that we like, where again, with competitive intensity, with the third player sort of facing, still struggling. So you can look at stocks like Bharti, for example. Or one could look at still, I think real estate still looks good to us. We're going through a little bit of a slowdown this quarter and maybe another 1 month or two, but that's structurally on a strong upcycle. There's plenty of demand out there. People are looking to upgrade. There's not enough, it takes time to put supply online. So, some of these are the sectors that we like. We would stay away from some of the defense type of names. We have been cautious over there. We still remain cautious, even though these stocks have corrected in some cases 30, 35, 40%. But still, from a valuation perspective, still expensive, would be a bit cautious. As far as the other capex plays are concerned, we think one can selectively start getting in. I can just share one name. We just today have upgraded Larsen and Toubro, just given how the stock price has declined. But even then, it's not a strong buy at this current valuation. It's something we like, but from a longer term scenario. But again, in the short term, next 3-6 months, this may just about move sideways. So basically shift to quality, shift to defensive, protect your returns, move to large caps away from small mid caps, where typically the valuation is a bit more frothy. So that's sort of the broad approach we are recommending right now. And consumption, we think it's still a bit too early. This slowdown could persist. You first need more of job creation, exports picking up, agricultural income coming through, government capex to pick up, then you will start see a consumption pick up. So that's still, we think, probably 2-3 quarters away.
Hi, Pratik. Good morning. Good to see you in. I think from the consumption basket, you were leaning more towards staples versus discretionary, I think, a couple of months ago when we spoke. So is that still your preference? And also, the next indicator that we'll be getting with regard to how's the economy shaping up will be the auto sales. And the commentary has been mixed. The numbers as well on some counts have been disappointing. How are you approaching that space, the auto space? What do you prefer, two-wheelers?
Firstly, on the staples versus discretionary, yes, in a weaker consumer environment, people will spend on the essentials, and the potential for upgrading, premiumization would be somewhat limited. So focus more on the staples, less on the discretionary. Discretionary usually picks up when when income levels are good and people are willing to spend. That's not the case in the current scenario. So focus on staples. As far as autos are concerned, we have been cautious and we remain cautious. But at the same time, I would just say, I don't think things are as bad as perhaps the market commentary now is making out to be. We think a lot of the auto players have been far more disciplined this year in terms of stuffing inventory down the channel. Most of these companies report on their wholesale numbers, which can be quite misleading. So we think this time around, the situation is not as bad as it seems, but nonetheless, the overall weakness in the consumer space implies that auto sales will also remain weak, probably in single digits for both PVs, passenger vehicles, and for two-wheelers. In two-wheelers, we would still be cautious given the increase in competitive intensity. You've got the pure EV players who are who remain quite aggressive, and meanwhile the incumbents are also coming back, and they're also ramping up in their distribution and product launches and so on. So autos, we would be careful. The only stock we like there is probably M&M, which will benefit from the tractor upcycle in our view.
Okay. Just briefly, Pratik, two things if you can address. One is, had China not risen, right, from the ashes, if I can put it a little dramatically, would all of this slight slowdown at the margin, etc., have mattered? Because now that's in a way, legitimate competitor for foreign flows, right? So you've got options in that sense. That is one. Is that what has changed for foreigners at the margin? Another option. And the second, you said this consumption slowdown could persist. And then you said some of job creation. Those are all structural, fundamental kind of issues, right? Which take time to resolve. It's not something you can do just like that. So this slowdown perhaps could persist because the general feeling is the top end of the consumer is kind of maxed out. At the lower end, there isn't very much happening. And the middle part, I mean, the upper middle part is also has spent itself out quite aggressively over the last 3-4 years. So go on.
Prashant, yes, by and large, agree with you. First, on the FII part, yes, China was the main trigger. But even before the China factor, FIIs were not really overly enthused with India at the valuations we were in back in August or early September. So they have been complaining about high valuations. We were not seeing fresh money coming to India in a big way, apart from some of these IPOs and blocks and QIPs, which was very tactical. The bulk of the outflow that we've seen from FI so far is really from index funds, from hedge funds, from proprietary trading desks who trade India sitting out of the region. This is somewhat more what I would say tactical, somewhat more momentum type of money. The deep long-only money is yet to move out of India in a big way. If I remember correctly, FIIs own about $850 billion of Indian assets, Indian equities. And so far, we've seen only $12-13 billion or so moving out. So if China really were to take off, you could see a lot more selling. But that's not the base case. That is not what most people expect. There are structural issues in China which will take a long time to resolve. A little bit of stimulus here and there could lead to a rally in the short term, but most folks are still, sort of skeptical. So that's as far as the foreign selling is concerned. It was more our own valuations which were keeping foreigners away. China just turned out to be a trigger to book some profits in India, move on elsewhere. As far as the consumer side is concerned, I think one or two important factors to keep in mind. We've also had very weak government spending in the last 6 months from, let's say, April, May till September, October. And the government is now sort of, realizes how it's been falling behind. And we think in the second half of this financial year, we will start seeing a very sharp uptick, although it may still not catch up to their full year targets. But you will see an uptick. IT services, which is another source of high-end jobs in India, that, again, the worst is over. Till 6 months back, you were seeing IT companies still cutting net headcount. Now I think it's getting to neutral, and in our view, will start turning a bit more positive as we go into the second half. And also, the rural income, monsoons have been good, so the farm income should pick up. Exports, we had the worst of the Red Sea crisis, freight rates going through the roof. European and US economies doing not so well. Now, those things are all, again, the worst is over. So export should also perhaps not do as badly. So overall, it will pick up, but as you rightly said, it may persist for a bit longer. I don't think it'll last for, we structurally, the economy is doing well and we are recovering post-COVID, so that recovery should continue. The consumption recovery, all we are saying is will take a bit longer. It won't recover until,
Sure.
some of things start working out.
Okay, all right, Pratik, got that. Thank you very much. That's really helpful perspective. We'll keep it in mind. Once again, wish you season's greetings and a great festive weekend as well. We look forward to connecting again soon.
Thank you.
Thank you.